Hello everyone, and welcome to our lesson on interpreting the order book. Interpreting the order book is probably one of the more critical skill sets that you can learn as a day trader, and for me personally, it was probably the biggest single light bulb moment in my day trading career. So I'm excited to share it with you. Let's hop into it. Okay, so decent bit to cover today. Quick outline first. We're going to start by just talking through the absolute basics of level 2 so that you understand how to read it and interpret it. And then after that, we're going to get into a refresher on the basic law of supply and demand in economics, which you'll need to at least have a decent grasp on to really fully comprehend what you're looking at. And then we'll get into interpreting level 2, how you identify strength, weakness, and balance. And then finally, we'll end with a quick note on market makers and spoofing and an introduction to a really cool tool called Bookmap. So lots to cover. Let's get into it. Alright, so we're going to start out with some quick level 2 basics. Level 2, which is also referred to as market depth, displays all quotes being sent to specific exchanges. So if you look at my level 2 off here to the right, notice that down at the bottom I have 4 tabs. I have a tab for each exchange, INET, ARCA, and IEX, and then I have what's called a montage tab, and your platform might call this something else. Mine is Dash Trader Pro, so for whatever reason they refer to it as a montage. And this combines all of these tabs into a single tab so that you can see all of the orders in one spot. So on the left-hand side of this level 2, you have all of the buy orders that are currently out in the market. So at $81.40 here, this market maker ID has an order out for 190 lots. That is 19,000 individual shares that somebody wants to purchase, again, on AMD at $81.40. So that's how you would interpret this left-hand side. The right-hand side is just all of the orders that people have out in the market where they want to sell. Now, the key takeaway here is that this level 2 and all of these orders is our window into the supply and demand zones of a stock. We can see where people want to purchase or want to sell the stock, and that's incredibly valuable information. But the one thing that I do want you to keep in mind is that these are just effectively the limit orders. Think about it like that. These are the orders where people are telling us that they want to purchase. It's always possible for people to come in with market orders that just instantly get executed up here at basically the very top, and they aren't therefore reflected on the order book. So just keep that in mind, but we'll get into that in more detail in just a minute. Before we get into interpreting the actual supply and demand zones on our level 2 though, I need to give you just a quick Economic 101 refresher. If you've never taken an economics course in your life, don't worry about it. We're going to keep it super basic. I would just maybe recommend printing off this page and keeping it with you as you practice these concepts. So the main thing I want you to remember for our economics refresher is that price fluctuates and moves in the market because of a mismatch of supply and demand. And the only time that price remains stagnant generally in the market is when you reach what is called an equilibrium price. So that's when both supply and demand are at essentially the level they want to be at and they agree on price. So understanding the changes in supply and demand will help you understand price movement. And our level 2 gives us a glimpse into the balance or imbalance of supply and demand, which in turn, as I said, can help us predict where price is going to move. So I want you to keep in mind kind of a couple of basic supply and demand concepts that I've drawn out in visual over here on the right. These are basically the exact same thing. They're just flipped for price going up or price going down. But the first one is if demand for any good or demand for a stock goes up and the supply of that stock or good stays the same, price is going to go up. A real life example of this would be, say, a popular concert. The venue only has a set number of seats, so supply is stagnant, but maybe there's tons and tons of people that want to go see this band, and so demand is going to go up, therefore driving up the price of those tickets. The second concept is if demand remains stagnant and supply goes down, then price is going to go up. An example of this would maybe be a really nice vintage luxury car, like some old Ferrari or something. Supply of those is only going down over time, right? They're not making any more of them, and some of them eventually are breaking down or dropping out of the marketplace. But if demand for those kind of remains roughly the same as supply decreases, it's still going to cost you more to get one. And then the third concept is that if both of these things are happening, you kind of get obviously an increase in price, but an even more dramatic increase in price. The same exact thing works in reverse. So if, again, demand goes down, supply is stagnant, price will decrease because nobody wants the good. If demand is stagnant, but you increase supply, so somebody floods the market, again, price will go down. And once again, if both of these things happen in tandem, price will decrease even more rapidly. So those are our kind of economic refresher concepts. Again, print this page off if you feel like you don't understand this, and keep it next to you as we go through some examples. All right, so we've got our economic refresher out of the way. Now we're going to apply that to a real-world example on Apple. And this is an example of how to interpret a strong or bullish level 2. So if you look at our order book of Apple, the current price is sitting at $153.36. What you can see on the ask side of the level 2 are a bunch of people that want to sell at 153.50 and 153.60 and 153.70. So you have this kind of quote-unquote ladder formation that is forming to the upside of the stock. Because again, price is sitting at 153.36. So most of the people, the larger participants, want to sell at a level above where the current price of the stock is. So what you need to do when you interpret this order book is put things into the perspective of supply and demand that we talked about on the previous slide. So you have two parties. You have sellers, and those sellers kind of consist of the smart money and the retail traders. Let's break it into those two buckets. The smart money is refusing to sell at the current price because they have a high conviction that price will move up. So again, they put thousands and thousands of shares out for sale above where the current price is. What this does is it decreases supply at the current price levels. So no one wants to sell right here. They all want to sell further down. Now, the retail side of the house, if they're more established prop traders or they're more experienced individual retail day traders, they'll also see this level 2, and now you will as well. And you'll understand that the larger participants want to sell up here. Well, I'm going to hold as well then, and that will again decrease supply. On the buy side or the demand side, once again, we'll talk about the two participant groups. The smart money, spoiler alert, has done the smart thing, and they're probably already in a position, but knowing that there's so many orders to get filled up here, they will also think about buying up pullbacks because, again, they expect price to increase. So that increases demand. The retail side of the house, they might not see this at all. They might not have a level 2 on their platform, and so maybe their demand remains flat, or they're interpreting the price action. They see that the stock is going up, and so they'll also want to jump in and have FOMO, and that therefore, once again, increases demand. So what is the net result of this? The highest probability result is that you have this decrease in supply that we talked about from the sellers and an increased demand from the buyers. Therefore, price will go up. Or you could also think about it as having stagnant demand, because maybe the retail traders are a bit clueless, and you have decreasing supply, which once again will drive price up. So the highest probability scenario when you see a level 2 that looks like this, where you have a ton of stacked orders to the ask side and nothing really to the bid side, is that price will probably move up to go fill those large orders. Okay, so now I want to show you the charts and what those would have looked like as you were watching this. So again, we were able to tell just by interpreting the order book that the most likely scenario was that price was going to move up to these big blocks of orders at $153.50. And you can see that what was taking place here was actually kind of a consolidation around this 153 level. And if you remember back to our volume, our trend continuation volume profile, you had a strong move up on good volume and then a low volume decreasing pullback. So this would have been a really good kind of continuation play. And I did actually take a trade on this, but that's not the point of this slide. The point is that, again, the most likely scenario as you were looking at this would be that price would move up to these large orders. And you can see that later on in the day, it did actually move up to those large orders around 153.54. And at this point, when I took this screenshot, there was actually another stack of orders up at $154. So you could have even continued to hold this and ride it up for the entire rest of the day, essentially. So that's an example of how you would interpret a strong bullish level 2. Now let's get into the flip side of that with a weak level 2. Now we're going to look at an example of a weak or bearish order book. Here on INTC, Intel Corporation, we see that there are large orders still to the top side, but the downside ladder has significantly more liquidity, right? You have 20,000 shares, 10,000 shares, 30,000 shares, 40,000 shares, all stacked down below you on the bid. So once again, what we're going to do is consider the psychology of the current supply or sellers and the buyers or the demand side. So on the sell side, in this particular example, you have once again the smart money, and the smart money is obviously convinced that price will move down. And they've either already exited their positions around the current price, or they're actively shorting, and these are actually profit targets down below. Thus, we get an increase in supply at the current price, right? The retail side of the house, depending on what is happening in price action, and again, we're ignoring the chart for now, but retail traders might be holding, they might be panic selling as price fails to move up, and ultimately this is either going to be flat supply or increasing supply, once again, at the current price levels. On the flip side, you have the buyers, right, that have already stacked on the bid. And so you have the smart money, which has put profit targets out for the shorts that they're executing up here, or they are looking to enter at a better price because they're kind of a longer term participant, maybe a larger fund or just a larger individual participant, and so they're willing to enter on limit orders. So again, these are either profit targets for shorts or longer term participants that want to enter at a better price. Either way, for the current price levels, we get a clear decrease in demand. The retail side is likely blind to a lot of what's going on here, and so it's probably a combination of buying right at the very top, which retail traders are great at doing, profit taking if they were in a position, or potentially even panic selling. The result of all of those, we're just going to say, is kind of flat, a wash in terms of demand. So the highest probability result, therefore, is that we get a decrease in demand, an increase in supply, and therefore price drops. Or demand goes down while supply remains steady, once again resulting in a price drop. So let's see what happened on the actual chart. So I actually took this screenshot that we saw in the previous slide, basically right before the market opened. And you can see that we already had all of these big orders stacked to the downside, particularly around 26.78, we had some very large orders. So when the market did open, what happened was we got a quick price flush, a bunch of buying that kind of squeezed out some shorts, went back up, tagged these prices here, and took out all of those orders, and then proceeded to flush back down, basically tagging 26.78 almost perfectly, you can see, like right here, like 26.78 would be right about there, and that's where our big orders were sitting. So that's an example of a weak or bearish level 2. Now let's get into how we interpret balance. Okay, so now we're going to get into our third order book interpretation scenario, which is balance. Balanced order books are going to show no clear imbalance or excess to either side. so neither supply nor demand. And when the order book is imbalanced, you will very commonly get choppy or indecisive price action. Because of that, it is almost always better to just wait for one side to either build or lose orders before you execute a trade. So remember back to our supply and demand basic concept slide. If you have an equilibrium price, that means that demand and supply are essentially in agreement. Everything is just in equilibrium. There's no reason to be taking a trade because the most likely scenario is that you're just going to chop sideways. So here are two examples of that, one on Intel and another on AMD. On AMD, you can just see that there really aren't any large orders on either side of the order book, and even the small orders are almost perfectly matched on either side. So you have like a 16 here and a 20 here, 12 here and a 15 here. It's almost perfectly balanced. Same thing with Intel over here to the right. Yes, you have large orders on either side, but they balance each other out. So in both of these situations, you really just don't want to take a trade because there's no clear indication to which side we're going to break. Okay, so at this point in the lesson, I hope that you see the value of the order book and how it can help us identify the highest probability scenario. But as with everything in trading, it's all just a game of statistics, and ultimately the highest probability scenario does not mean the order book is going to allow you to have some crazy 99 or 100% win rate. So there are two different signs that you should look for that signal kind of a breakdown in the bullish or bearish order book scenarios that we discussed in the previous slides. The first of these is called an iceberg order. Iceberg orders are humongous orders. I'm talking hundreds of thousands of shares that are not on the order book until price approaches a level, and then after we bounce away from that iceberg, you'll see that order disappear in the order book. So I don't have a great example of this on this slide because they're pretty hard to capture in real time, but essentially what happens is, let's say price is going up to this level. Right before we hit this level, you'll see 100,000 shares or more pop onto the ask, trying to get filled. Ultimately, what will happen very frequently when you get, again, an iceberg-sized order is you'll get a flush away from the order, and it will try several times to break through because, again, they're trying to fill such a ginormous order. So while ultimately the order book is correct in that price will move towards this large order, you could get chopped around dozens of times before you actually get the breakthrough of that iceberg. So really, you're better off just avoiding these if you see them. The second scenario that you're going to want to avoid is climactic volume ahead of very large orders. So when climactic volume happens just in front of these orders, it can be a signal that those orders are actually going to get left behind, that everybody else is bailing, and potentially even the person that set these orders out here is selling ahead of them because they don't actually think that it's going to get to this price exactly. So they're just trying to get the best fill they possibly can before price ultimately rejects. And so what that is going to look like is this example over here on NVIDIA. So you move up to this 238 price level, and you can see that on the order book at 239, which is right here, you have a 15,000 share order, which for NVIDIA is quite large. But what you see happening is you get these climactic volume, very, very large volume over a narrow range candle right at this level. And so it's clear that while, yes, there's a large order up there, everyone else is bailing on their positions, taking profit, and we're more likely to reject here than we are to go fill that large order. So you really do have to combine, price action analysis with reading the order book, with doing volume analysis, like in lesson 1.2. All of that stuff in combination will allow you to greatly increase your win rate. And so you can see what ultimately happened on NVIDIA here after these two large climactic volume events is that we did reject down for basically the entire rest of the day. So those are two examples of how the order book can fail. I now want to just take a brief aside to talk about spoofing. You might be thinking at this point in the course, well, hey, if the order book is so great and everybody's looking at it and it's giving us the highest probability scenario, why wouldn't a really large player just put orders out on the market book to kind of quote unquote trick the market into moving higher or lower? Well, you're not the only person that's thought of this, and there's a reason people don't do it. It's because it's illegal, and it's called spoofing. Spoofing is when you place no intention to fill orders out in front or below the price to basically entice the price to move higher or lower. Now, this is my tinfoil hat, wink wink. Spoofing is illegal, and it never happens. And in case the sarcasm in my voice didn't come across, spoofing absolutely does happen. There are absolutely orders that are put out there in the market by very large players that they have no intention of filling. However, it is almost impossible for them to get caught because ultimately at the end of the day, all they have to do is say, hey, we thought we were going to fill those orders and the market changed. The environment, the landscape of the current order book and everything else, yada yada, changed. And now we didn't want to fill those orders. So once again, there's really nothing we can do about this as traders. And yeah, it does happen. It's definitely not very common, but I have seen situations where it was fairly clear that somebody was putting out and pulling away orders just to basically force the price lower. But once again, the reality of the situation is that we, as day traders, are just trying to find a statistical edge in the marketplace. And the order book certainly works more often than it does not. The last thing I'll say on spoofing is that if you ever want to see a really fantastic little mini documentary on a kind of real world example of where spoofing blew up the market for a few minutes, go watch the Wild Ride of the Flash Crash Trader on YouTube. This is the name of the video right here. It's only 25 minutes long. Again, absolutely fantastic, very interesting read, and it'll give you a little bit more of an example of why spoofing is and definitely should be illegal. The second aside that I want to go through for this lesson is just a quick note on market makers. Market makers, as their name implies, literally make a market. They do this by holding enough inventory that they can facilitate transactions between buyers and sellers. So they are the middleman. Market makers provide liquidity to the market, which is extremely valuable because that allows people like you and me to get into and out of positions extremely fast. They are rewarded for providing this liquidity by collecting the bid-ask spread. So if there's a 1 cent bid-ask spread on Apple, every single time you transact a share on Apple, they get 1 cent. Again, this is compensation for holding very, very large positions. So the reason, therefore, that you'll see stocks have a larger or a smaller spread is often because they are either less liquid or more volatile. Therefore, holding a large position is essentially more risky than if the stock, again, was something like Apple, where millions and millions and millions of shares get traded every single day, and the stock price is relatively stable. The key takeaway here, as it relates to the order book, is that market makers have an inherent desire and an inherent bias to help push the market in the direction that will result in the largest amount of participation, right? Because they want to fill those orders because they get paid the bid-ask spread. So if there is a 100,000 share order sitting down here and price is just moving along here, market makers have a bias, an inherent desire, again, to make sure that that order gets filled because they're going to get paid 10 cents or 1 cent on all 100,000 shares that gets transacted. So all I'm trying to get across with this slide is that market makers and every other participant that's looking at the order book are all essentially making the same decision, and that's why this stuff works as frequently as it does. So with that, let's move on. The last thing I want to do with this lesson is just to quickly introduce a tool called Bookmap. Bookmap is a very cool tool that presents the level 2 and market depth information that we've been talking about in this lesson as a heat map. A couple things that I'll say before we get into an example of the tool is first that the desktop software is, in my opinion, kind of too expensive to warrant buying. But at least as of the time of recording this lesson, you can actually get a lighter version with pretty much all the functionality you need that integrates with the Thinkorswim platform from TD Ameritrade for only $40 a month. So again, that's as of me recording this. I have a couple recommendations that I want to give you, even though this lesson is not in any way, shape, or form supposed to replace the lesson in section 2 of this course on choosing a platform and a broker. But since I'm introducing the tool, I want to give you my recommendations on it now. If you don't want to pay for Dash Trader Pro, which is $150 a month and is fairly expensive, and you want to use Thinkorswim, which is a free trading platform, or any other free trading platform, I would recommend paying the $40 a month for this software because Thinkorswim doesn't really have that great of a level 2. However, if you already pay for Dash Trader Pro or another system that has a really good level 2, don't bother paying for Bookmap because you're just going to end up splitting your attention between two different softwares. And I think, in my opinion, that's going to hurt you more in the long run than just focusing on learning the system that you do already pay for. So now a quick example of what Bookmap looks like. So on the left-hand side, you have Bookmap. On the right-hand side, you have a traditional level 2, like what we've been looking at on all the other slides in this lesson. On Bookmap, you have price on the y-axis, and it displays the orders as heat bars. The darker the heat bar, the larger the order. So this is a snapshot of Apple at the exact same time as the snapshot on Bookmap, and you can see that I have large orders at $152.50, and I see that exact same thing here as a yellow heat bar. I also have very large bids stacked down at $151 on Apple, and you can see once again that that's displayed as a large red heat bar. So this can be a nice visual way for people that kind of aren't as inclined to just look at numbers on either side of the bid and the ask, right? If you're a very visual learner or you just like the way that this is presented better, could be a good option for you. All right, so that brings us to the end of our lesson on interpreting the order book. I hope that this was an aha or light bulb moment for you as a trader and that you got a lot out of this lesson. As always, I want to leave you with just a couple of quick closing comments. First, please always be aware of the current state of supply and demand on your level 2 before you execute a trade. Because, as we've talked about, these clear pockets of liquidity are going to draw interest from both market makers and standard market participants. Utilizing these strong and weak order books is a vital part of my system, and it will greatly improve your accuracy if you can master it. So I hope you got a lot out of this lesson. Have a great day, and I'll see you in the next one.